The move is already underway, and the people trying to frame it as a spike are missing the part that turns a rally into a re-rating event. Silver just printed above $90, tagged the low 92s, and then ripped back under 90 in a heartbeat, right in the middle of repeated margin hikes and the kind of volatility that usually ends a party. And yet it didn't die. It stayed bid. That's the tell. Because when trading gets more expensive and the market still refuses to let go, it's not just emotion anymore, it's pressure in the plumbing. And before we're done, you'll have a clean near-term roadmap. The few price levels that actually matter. The calendar window that can force acceleration, what would confirm a fast push toward triple digits, and the one thing that would invalidate this whole $100 scenario if it shows up. Here's what most people get wrong when they talk about silver at this stage. They look at the chart like it's a story about buyers and sellers. But at record highs, the silver market stops being a story and starts being a risk management problem. There's a huge difference. Risk management problems don't resolve politely. They resolve with forced behavior. Dealers hedge, funds rebalance, shorts pay up or get out. Physical buyers pull forward demand because lead times and premiums don't care about your opinion. And the next detail is what flips the whole setup. Silver is becoming mechanically harder to hold, right as it's becoming easier to justify. That sounds backwards until you look at what just happened. In mid-January 2026, silver surged through the $90 line, an all-time psychological barrier, printing around $91 and $92 per ounce on major benchmarks. Then, almost immediately, you got the snapback, down into the high 89s, even flirting with the upper 80-somethings in a sharp pullback. To a casual observer, that looks like blow off and fade. To anyone who has lived through commodity squeezes, that looks like the first violent attempt to shake out leverage after the regime shifted. Because in a real squeeze, the market doesn't reward you with a gentle staircase. It weaponizes volatility. It punishes late chasers and impatient holders, and it tries to convince you the move is over, right before the next leg starts. But that's not the part that matters. The part that matters is why silver did not collapse after the cost of carrying a position got pushed higher. Over the past couple of weeks, CME raised margin requirements multiple times, and then moved precious metals margins to a percentage of notional approach, meaning as price rises, the margin burden rises automatically. Put simply, as silver goes up, it becomes more expensive to stay long and more expensive to stay short. That system is designed to reduce stress by forcing speculators to shrink. In many markets, that's the kill switch. In silver, it can become a filter, because when the market shrugs off higher margins and still holds key levels, it implies there's demand that is not purely leveraged momentum. And that's where the real pressure starts. Now layer in the calendar. This week and the next 2 weeks are not random. Late January is a compression zone for liquidity and positioning. You've got month-end flows that force funds to mark and rebalance. You've got options positioning that can pin price to key strikes until it breaks, and then the hedging becomes gasoline. And you've kind of got the psychological magnet of a round number 100, sitting close enough that it changes how options are priced, how dealers hedge, and how momentum money behaves. Once the market senses that $100 is reachable, you don't need a new headline every day, you need math. Because if this one level breaks, the math changes. Let's make that math simple without dumbing it down. In options markets, a lot of call buyers don't buy calls because they want a lottery ticket. They buy calls because the convexity is efficient. A call option gives you upside exposure with defined risk. Fine. But the hidden mechanic is what the dealer does on the other side. If the market buys calls, dealers often end up short those calls. And a dealer who is short calls has a problem. If price rises, their position loses money faster and faster. The way they manage that risk is by hedging, usually by buying futures or spot exposure. That hedge is not a one-time purchase. It changes with price. That's delta. And the rate at which that delta changes is gamma. When price approaches a heavily populated strike, like $100, gamma can rise, meaning the hedge needs to be adjusted more aggressively for each dollar move. That's the reflexive loop. Calls get bought, dealers buy silver to hedge, price rises, delta increases, dealers buy more. It's not a conspiracy. It's a seatbelt that turns into a slingshot when the car accelerates. Here, S the micro cliffhanger. That loop only matters if the market stays in the zone long enough for it to bite. That's why the calendar matters. Option expiries, month end, and thin liquidity can cluster hedging flows into a few days where price discovery gets jumpy. The next detail is what flips the whole setup. Silver doesn't need on everyone to believe. It needs a narrow set of participants to be forced. If price sits near a strike that matters, dealers become price-insensitive buyers. If price breaks above a breakout level, shorts become price-insensitive buyers. And if physical tightness shows up, refiners and fabricators become price-insensitive buyers because they're protecting throughput, not maximizing entry precision. 3 different forced buyers, same direction. different reasons. And that's how you go from nice rally to fast acceleration. But we need proof, not vibes. So let's stack it the way professionals do. Structure, flows, physical signals, macro, and the counterpoints that could kill the idea. Start with structure. Breaking above $90 did more than print a new number. It changed the psychology of every book that benchmarks risk around prior highs. When a commodity clears a multi-decade ceiling, you get a re-rating effect. Models that rely on volatility regimes reprice. Risk parity and trend followers, think CTAs, react not because they're excited, but because their systems are built to add exposure when trend strength rises. That doesn't mean automatic moon. It means underlying demand for exposure can persist even after pullbacks. And the chart itself becomes a map of forced decisions. In this setup, there are three key zones: a floor, a pivot, and a door. The floor is the support band that, if it holds, tells you the market is absorbing margin pressure and profit taking. Right now, that's roughly the high 80-somethings into the mid to upper 80-somethings, depending on the benchmark you track. If silver repeatedly flushes into that zone and snaps back quickly, it's saying dips are being bought despite stress. The pivot is $90 itself. Not because it's magical, but because it gets where a huge amount of positioning flips from in profit to underwater, and where headlines shift from record high to failed breakout. Oh, the door is the prior peak area in the low 92s to mid 93s, because that S, where the market proved it could trade, and where a reclaim can trigger a second wave of trend validation. If price can reassert above that door and hold, $100 stops being distant and becomes a nearby liquidity event. And that's where the real pressure starts. Now flows. The silver market is not just futures. It's also investment vehicles that warehouse metal and translate public demand into physical allocation. A major proxy here is the Big Silver Trust that holds physical bars and issues shares. When inflows hit, metal gets allocated. When outflows hit, metal can be released. The key is speed and scale. In calm markets, those flows are background noise. In stress markets, they become gravity. Because the underlying silver market is not infinite, the float that can move quickly is smaller than people think, especially when you separate silver that exists from silver that is available at a price people will actually sell today. That distinction matters. Eligible metal is not the same as deliverable metal. Inventory on paper is not the same as inventory that will be tendered when the market demands it. And when investment demand rises quickly, even if it's just paper, it can lead to real-world demand for bars and coins that bottlenecks downstream. But that's not the part that matters. The part that matters is how physical tightness shows up before it becomes obvious. It usually appears as spread behavior and immediacy premiums. In a commodity market, the futures curve tells you what the market pays for time. In contango, future prices are higher than spot, reflecting storage and financing costs. In backwardation, spot is higher than futures, implying that near-term metal is valued more than later delivery. Backwardation can be caused by genuine shortage, by financing distortions, by location mismatches, or by a scramble for specific deliverable forms. But when you see persistent or record backwardation behavior in silver, it's the market whispering, the immediate ounce is the scarce ounce. That's not a meme, that's a signal. And it connects to another underappreciated mechanism, leasing and borrowing costs. In normal times, borrowing silver short-term in major hubs can be near zero-ish. When demand for immediate metal rises, whether because someone needs to deliver or because someone wants to move metal before a policy change, those costs can jump. Recent market commentary has pointed to leasing rates surging into multiple percentage points at times, and to US futures trading at a premium to other benchmarks. You don't have to worship any one metric. The point is the direction. When the cost to source metal jumps, someone is paying up for time-sensitive availability. And that is exactly the kind of hidden pressure that can overwhelm paper calm. Because if the market is paying for immediacy, it's telling you the physical chain is not frictionless. And the next detail is what flips the whole setup. The supply side can T-sprint to meet a sprint. Silver supply is stubborn. Most people still talk about it like a pure mining story. It's not. A large share of global silver production is a byproduct of mining other metals: copper, lead, zinc, gold. That means a higher silver price doesn't instantly lead to more silver mined, because the primary decision to expand production depends on the economics of those other metals: capex cycles, permitting, labor, energy, and refining capacity. Even when miners want to increase output, lead times are measured in years. Refining and logistics add more time. Recycling helps at the margin, but recycling is also price and process dependent, and it doesn't scale overnight without capacity. So when investment and industrial demand surge together, the short-term response is not more supply, it's more stress. Or stress in inventory, stress in spreads, stress in premiums, stress in delivery dynamics. And stress is what creates price discontinuities. Now bring in industrial demand, because this is where $100 stops sounding like pure monetary speculation. Industrial buyers don't care about your chart. They care about throughput. Silver is used in electronics, in soldering, in high-performance components, in the build-out of electrical infrastructure, and in various energy transition and automation supply chains. In 2026, we're not in a world where industrial demand is a cute footnote. It's a structural bid that can be surprisingly inelastic in the short run. If you're a manufacturer and your inputs are threatened, you don't wait for a dip the same way a retail trader does. You hedge, you pull forward purchases, you accept higher prices, because the alternative is production stoppage or missed delivery commitments that cost far more than a higher metal price. That's why industrial demand can act like a silent accelerant. It doesn't tweet, it just buys. But that's not the part that matters. The part that matters is what happens when industrial demand and investment demand collide inside a market where liquidity is thinner than it looks. Silver can be deceptively small compared to the scale of global capital. It doesn't take a massive shift in allocations for price to move dramatically. A small percentage of funds deciding they want precious metals exposure, or they want inflation hedges, or they want commodity beta, as geopolitical risk rises, that can be enough to push the market into zones where hedging flows and short covering start feeding the move. And yes, geopolitical risk is part of the backdrop right now. We've seen heightened global tensions contribute to a broad metals bid, not just in gold and silver, but also in industrial metals like copper and tin. That matters because it suggests the bid is not purely fear trade. It's also inventory behavior, supply chain hedging, and policy-driven shifts. There has been talk of stockpiling and tariff concerns pulling metal into certain regions. When markets anticipate tariffs or restrictions, the rational move is to front-run supply. That creates localized shortages, which then create arbitrage incentives. And arbitrage is one of the cleanest, non-emotional drivers you can have. Arbitrage is simple. If silver is effectively more expensive in one place than another after you account for transport, financing, and form, metal gets pulled toward the premium. That pull can show up as higher futures spreads, as elevated leasing rates, as persistent premiums for coins and small bars, or as unusual behavior in deliverable inventories. It's not mysterious. It's a magnet. The market moves metal toward urgency. And if the urgency is in the near term, price discovery shifts from what is silver worth next year to what is silver worth right now. And that is how a market can accelerate fast. Now let's talk about the force that tries to slow this move, because you need that for credibility. People love to say manipulation. The more accurate framing is incentives and risk control. When volatility spikes, exchanges raise margins to protect the system. Brokers tighten risk. Market makers widen spreads. Funds with VAR constraints cut positions because their models tell them risk has increased. Media narratives swing wildly because volatility makes people crave explanations. None of that requires a hidden villain. It's just how stressed markets behave. But the consequence is the same. Volatility becomes a tool that shakes out weak positioning. And silver, more than many assets, loves to weaponize volatility because it sits at the intersection of commodity, monetary metal, and speculative battleground. That is why you can be right directionally and still get emotionally broken if you don't understand the game. And that's where the viewer psychology shield matters. Here's the shield. In a market like this, your enemy isn't a person. It's your own impulse to interpret every red candle as a verdict on the thesis. You need to separate trend signal from noise. Trend signal is the ability to hold higher lows after a breakout, the ability to reclaim pivots quickly, the behavior of spreads, and term structure, and whether big levels act like magnets or ceilings. Noise is intraday whipsaw, headline-driven spikes, and engineered-looking flushes that happen when liquidity is thin. In a squeeze-prone market, noise is not a bug, it's the method. The market shakes the tree to see who falls out, then it climbs. But that's not the part that matters. The part that matters is whether the market keeps leaving clues that buyers are forced, not fickle. And right now, the clues are stacked. 1, price has already proven it can trade above $90, meaning that ceiling is now a battlefield, not a fantasy. 2, margin hikes and a new margin methodology didn't end the bid. They increased the cost of participation, and the market still held relatively firm. That implies demand is deeper than cheap leverage. 3, the broad metals complex has been bid, suggesting either macro demand, policy risk, or supply-side disruptions are in play beyond just a silver story. 4, there are signs of near-term tightness language in market commentary, backwardation and leasing cost chatter, pointing to immediacy being valued. 5, the calendar is tightening. Late January into early February concentrates positioning stress. 6, the psychological and option strike gravity of $100 is close enough to influence behavior now, not later. That's a lot of layers. And proof stacking is how you avoid being hypnotized by one chart. Now, because this is finance and not a fairy tale, we have to take the counterpoints seriously. There are at least three that matter. First, silver is notorious for violent drawdowns even inside bull markets. In risk-off shocks, silver can underperform gold because it has industrial beta and speculative positioning. Second, if rates or the dollar surge in a way that tightens global liquidity, commodities can get hit broadly as leveraged players de-risk. Third, if the physical tightness narrative is overstated and inventories prove flexible, meaning eligible stocks get registered, supply moves, and premiums normalize, then the urgency premium can fade and price can mean revert sharply. Those are real risks, and ignoring them is how you lose trust. So let's convert them into a two-scenario lens you can actually use, because the next detail is what flips the whole setup. You don't need to predict the future perfectly. You need to know what confirms which scenario in real time. Scenario 1 is the controlled pullback and retest. In this scenario, silver cools off, chops, maybe even dips deeper than people want, because leverage needs to be cleaned out and weak hands need to be removed. But the key is behavior. Pullbacks are met with quick buying. The market holds the floor zone. Again, think high to mid 80-somethings, and repeatedly reclaims the $90 pivot. Volatility stays high, but the structure stays constructive. Spreads don't collapse. Physical premiums don't suddenly evaporate. In that world, $100 is less about a straight line and more about a coiled spring. The squeeze doesn't happen because everyone gets euphoric. It happens because the market refuses to break down. And when it refuses long enough, positioning rebuilds and then a breakout through the door zone, low 92s to mid 93s, can trigger the next wave. That's where the real pressure starts. Scenario 2 is the continuation squeeze and gap risk. In this scenario, silver doesn't give you comfort. It reclaims the pivot quickly, punches back above the door zone, and starts trading like a market that's short of time. You'll see sharper intraday ramps. You'll see fewer deep pullbacks. You may see overnight gaps because liquidity is thin and stops get triggered. And if options positioning is heavy near $100, you can get that gamma-style behavior where every push higher forces more hedging, which forces more buying, which pushes it higher again. That's when $100 can print faster than people expect. Not because the world changed overnight, but because positioning and hedging flows changed the speed of the tape. But here's the warning. In squeeze mode, volatility becomes even more violent. You can get 3% up, 4% down, 5% up, all in the same day. People get emotionally shattered, and that's why you need levels, not feelings. So let's lock the roadmap. The floor, the zone where repeated dips must hold to keep the thesis intact. Call it roughly the mid to high 80s area in the current context, with the understanding that different benchmarks print slightly differently. The pivot, $90. If silver is living below $90 and can reclaim it on bounces, the breakout thesis weakens and you shift into range reversion thinking. The door, the low 90s, around 92 to 94, where reclaim and hold suggest the market is ready to press again. Then the magnet, $100. Not because it's mystical, but because it's where psychology, option strikes, and headline attention converge. In a market like this, magnets become accelerants. And here is the clean invalidation concept. If silver breaks the floor and stays broken, meaning it doesn't snap back, it doesn't reclaim the pivot, and the bounces get sold, then the $100 or fast acceleration scenario is off the table for now. Not forever. For now. That's the discipline piece. That's how you stay credible. Now let's talk about what comes next over the next week or two, because that's the payoff you were promised. First, watch how silver behaves around the $90 pivot into late January. Does it keep reclaiming that level quickly after dips, or does $90 start acting like a ceiling? Second, watch the speed of pullbacks. Are they deep and slow or sharp and rejected? A sharp rejection tells you buyers are waiting. Third, watch implied volatility in the way the market responds to up moves. If rallies feel sticky and don't fade immediately, it's often consistent with hedging flows leaning in. Fourth, pay attention to any chatter about spreads, backwardation, leasing costs, and the premium of near-term contracts versus later ones. You don't need to be an expert in term structure to see the signal. If the market is paying more for now than later, urgency is present. Fifth, keep an eye on month-end behavior. Funds that must rebalance can create odd flows that have nothing to do with fundamentals. If the market holds up through that, it's a strength clue. And sixth, keep an eye on the early February window because a new, smaller 100-ounce futures contract is scheduled to launch in early February pending approvals, which is a structural change that can broaden participation and potentially increase retail engagement in the derivatives market. That doesn't guarantee higher prices. But in a volatile moment, new access points can amplify activity, and that's not the part that matters. The part that matters is that these catalysts don't have to create the bull case. They just have to concentrate it. Think of it like compressing air in a cylinder. The fundamentals, supply constraints, industrial demand, macro uncertainty, provide the air. The market structure, Options hedging, margin dynamics, positioning provides the cylinder. The calendar provides the piston. When the piston moves, pressure expresses. And if the market has already proven it can trade above $90, the path of least resistance can shift upward surprisingly quickly. Now, I want to address something that skeptical viewers always say at this point. If it is so tight, why does the price whip around so easily? Because tightness and volatility are not opposites. They're often the same thing. When liquidity is thin, price can move violently on relatively small flows. When leverage is high, price can whip on forced liquidations. When market makers widen spreads, price can gap. And when a market is at a psychological threshold, participants overreact to every tick because they know the next move could reprice the whole game. Volatility doesn't disprove tightness. Sometimes it reveals it, but you still have to respect the weapon. Because if your plan is, I'll just hold through anything, you're handing your emotions to the tape, and the tape will take them. So here's the psychology shield in practical terms. Decide ahead of time what you're watching and why. Not what you hope, what you're watching. If you're watching the pivot at $90, your job is not to panic when it breaks intraday. Your job is to see whether it's reclaimed and held. If you're watching the floor in the 80s, your job is not to celebrate every green candle. Your job is to see whether the market keeps defending it after flushes. If you're watching $100 as the magnet, your job is not to assume it's a guaranteed print. Your job is to see whether the market can reassert above the door zone in the low 90s and build pressure into the strike zone. And if the market does run, your job is to remember that parabolic moves are designed to make you do something dumb, either chase the top or sell in terror on the first pullback. The market doesn't need you to be wrong on direction. It needs you to be wrong on timing and behavior, because that's how it transfers money. But that's not the part that matters. The part that matters is that a $100 print, if it happens, can change the narrative in a way that accelerates flows. Once a round number breaks, more participants feel allowed to act. Headlines bring attention. Some allocators who ignored silver because it looked sleepy suddenly treat it as relevant again. Trend systems that were underweight add. Shorts who were patient become urgent. And if physical buyers are already leaning in, the paper market can have to catch up to the physical urgency rather than the other way around. That's the quiet institutional behavior turning loud. Not because institutions are heroes, because they are constrained, because risk controls and mandates force behavior when thresholds are crossed. Now, let's be clear and responsible. None of this is a promise. It's a scenario analysis. Silver can absolutely reverse violently even if the long-term thesis is intact. You can have a 10% drawdown in a day in this kind of tape. You can have a 20% correction in a week if a macro shock hits and leverage unwinds. You can have a sudden everything sells moment where even the best setups get hit. That's why we keep the two scenarios. That's why we keep the levels. That's why we define invalidation. If your process can't survive volatility, your thesis doesn't matter, because your behavior will break first. So where does that leave the $100 scenario right now, this week? It leaves it closer than people are emotionally prepared for, but not in a straight line. If silver continues to defend the floor in the 80s and keeps reclaiming $90 on dips, the market is telling you the breakout is being absorbed, not rejected. If silver reclaims the low 90s door zone and holds, then $100 becomes a near-term target that can be reached on a combination of trend momentum and hedging reflexivity, especially if liquidity thins into the end of the month. And if, on top of that, the term structure continues to hint at urgency, premiums for near-term delivery, elevated borrowing costs, persistent physical demand, then the move can accelerate, not because people believe, but because the market structure runs out of slack. But if silver breaks the floor, fails to reclaim $90, and starts printing lower highs with weak bounces, that's the market telling you the fast acceleration thesis is postponed. Not canceled forever, postponed. That's how you stay sane. One last thing before we close, and as the part most people skip, the market will try to use your identity against you. If you're a silver bull, it will bait you into defending a narrative instead of managing a position. If you're a skeptic, it will bait you into dismissing signals because you don't like the crowd around the trade. Don't play either game. Stay in the middle. Be the person who watches the plumbing, the person who knows what forces participants to do, the person who can say, I don't need certainty, I need confirmation. That mindset is the edge. And if you want a simple checklist to carry into the next week, watch $90 as the pivot, watch the high to mid 80s band as the floor, watch the low 90s as the door, and watch how price behaves as we move through late January into month-end positioning. Watch whether pullbacks are rejected quickly. Watch whether volatility is being absorbed or amplified. Watch whether the market keeps paying for immediacy. And if you see the door reclaimed and held, understand what that implies. $100 stops being a slogan and starts being a strike zone that can trigger forced buying. That's not hype, that's mechanics. If you are the kind of person who rather understand the mechanics than worship the headline, you're in the right place. Stay close to the levels, stay close to the calendar, ignore the emotional noise, and remember, if this does go for $100, the market will try to shake you out before it pays you for being early. The next detail is what flips the whole setup. The most dangerous part of a bull move is the moment right before it becomes obvious.